Okay, let's kick things off by looking at a truly staggering number, $114.81 billion. That is the massive market capitalization of Fortinet as of mid-2026. To put that into perspective for you, this single cybersecurity company is literally worth more than several major automotive manufacturers combined. It is an absolute behemoth, and it's seen its value skyrocket by over 45% in just a single year. But that brings up the multi-billion-dollar question. Just because a company is huge and growing like crazy, does that automatically mean its stock is actually priced correctly? Welcome to the Explainer. Today, we're taking Fortinet, ticker symbol FTNT, and putting it through what we like to call the Guru Gauntlet. Basically, this is a rigorous stress test where we evaluate this high-flying tech giant using the legendary investment frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, and wrap it up with a modern discounted cash flow analysis. We're going to strip away all the market hype and look purely at the hard numbers and the actual business fundamentals.
Let's breeze through our roadmap real quick. 1. The Fortinet snapshot. 2. The Buffett lens. 3. The Lynch lens. 4. The Graham lens. 5. Discounted cash flow. And finally, 6. Our synthesis and final verdict.
All right, Section 1, Fortinet Snapshot, a high-growth cybersecurity giant. The sheer scale of cash this business generates is just fascinating. So Fortinet currently trades at $156.71 a share. In fiscal year 2025, they pulled in $6.8 billion in total revenue, which is incredibly impressive. But the absolute standout metric here is that $2.21 billion in free cash flow. That means after all the bills are paid and they've reinvested back into the business, they have over $2 billion in pure cash profit. And that's largely driven by their massive dominance in emerging networking and security. Moving right along to Section 2, the Buffett lens. Moats, management, and owner earnings. Warren Buffett absolutely loves an economic moat, and Fortinet's is incredibly deep. CEO Ken Shih points out that Fortinet has literally been merging networking with security for 26 years. In the enterprise software world, that is a massive competitive advantage. When a company integrates its security directly into its physical and cloud networks, using proprietary systems like FortiOS, it creates ridiculously high switching costs. Think about it. Once an enterprise installs Fortinet across their entire system, ripping it out is a massive, incredibly expensive headache. That right there is a textbook economic moat. But, and it's a big but, Buffett also demands a fair price. Now, we have fantastic owner earnings, that $2.21 billion in free cash flow we talked about. Plus, management is super shareholder-friendly. They just authorized a massive $10.25 billion share buyback, and we know Buffett loves a good buyback. But we have to weigh that against the asking price, a $114.81 billion market cap. We are talking about paying over 51 times free cash flow here. So while Buffett would undoubtedly admire the business quality in the management team, at $156 a share with zero margin of safety, he'd almost certainly lock his wallet and walk away. Section 3. The Lynch lens. Growth categories and the PEG ratio. Peter Lynch would look at Fortinet and immediately tag it as a classic fast grower. Just look at their first quarter 2026 data. Product revenue grew an astonishing 41% year over year, and total billings grew 31%. They are expanding rapidly into unified SaaS and security operations. And for Lynch, fast growers are exactly where the multi-bagger returns hide. But again, that's provided the valuation actually makes sense relative to that explosive growth. So does the valuation make sense? Let's dive into the math. Fortinet's high-end guidance for fiscal 2026 adjusted earnings per share is $3. At a stock price of $156.71, that gives us a forward PE ratio of 52.2. Now, if we assume a very healthy, pretty aggressive forward growth rate of 20%, which is fair based on their recent billings momentum, we divide that 52.2 PE by 20 to get our PEG ratio. The result? A PEG of 2.61. Peter Lynch famously looks for a PEG ratio of 1.0 or lower. A PEG of 2.61 basically means the market has already priced in years of flawless, perfect execution. Under the Lynch lens, this stock is priced for perfection, so we're looking at a likely hold or sell verdict at this specific entry point.
All right, Section 4, the Graham lens. The ultimate margin of safety.
Ben Graham is notoriously strict. He uses a defensive investor checklist, and Fortinet easily passes the first three. They have massive size with that $114 billion market cap, pristine financial condition flooded with cash, and incredibly stable growing earnings. However, they hit a total brick wall on the last two. Fortinet doesn't pay a dividend, which Graham strongly prefers for defensive stocks, and more importantly, their price-to-earnings ratio of over 50 completely shatters Graham's strict requirement for moderate valuation multiples.
And brace yourselves, because it gets rougher when we calculate Graham's intrinsic value formula, which heavily weights earnings against book value. Because actual book value per share isn't explicitly detailed in our snapshot, we threw in a pretty generous industry proxy of $5 per share just to run Graham's formula. Even with that, the intrinsic value comes out to a shockingly low $18.37. Graham's mathematical framework violently rejects a $156 stock price. It's a really stark reminder that Graham's conservative model simply was not built for capital-light, high-growth modern tech companies like this. Section 5. Discounted Cash Flow, or DCF, Modeling the Future. Okay, moving into the modern era. To build out a DCF model, we need explicit assumptions. We start with our actual known free cash flow, $2.21 billion. We project that out over a 5-year forecast period. Let's give them the benefit of the doubt and assume a really robust 20% growth rate during that time. For the terminal growth rate, meaning how fast they grow forever after year 5, we'll use a standard 3%. Finally, we apply a 10% discount rate, or WACC, which is a very standard baseline for a large cap tech company. Now, when we run those numbers through a sensitivity table, our base case scenario, right there in the middle, with a 10% discount rate and 3% terminal growth, gives us a fair value of $82.50 per share. Look at the surrounding possibilities. Even if we lower the discount rate to 8% and boost terminal growth to an aggressive 4%, the absolute most optimistic value we get is $148.20. And guess what? That is still below the current $156.71 trading price. The math is basically screaming at us that the market is expecting cash flow growth significantly higher than 20% for years and years to come. To really stress test our DCF findings, we need to apply some alternative models. First, running a reverse DCF, we find that the current $156 price tag implies the market actually expects Fortinet to grow its free cash flow at an unsustainably high 30% annually for the next 5 years, just to break even on value. Wow. Second, looking at a comparable company analysis, if we apply a more normalized industry PE multiple of, let's say, 35x to their forward earnings, it yields a fair value range much closer to $105. Both of these alternative models completely confirm what we already suspected. The stock is priced for absolute perfection. Section 6. Synthesis and Final Verdict. The price versus value dilemma. All right, here is the master summary. At $156.71, Fortinet frankly fails our quantitative tests across the entire board. To hit our DCF base case or the comparable models, we'd need a trigger price around $70 to $105. To satisfy Peter Lynch's PEG ratio, we need the stock to drop to $60. And Benjamin Graham? Well, he wouldn't even look at it unless it cratered near $12. The consensus from the gauntlet is crystal clear. It's a spectacular business and definitely a hold if you already own it, but it is simply way too expensive to buy right now with new capital. And that brings us to the ultimate question. The Guru Gauntlet proves time and time again that a great company and a great investment are two very different things, and it is entirely dependent on the price you pay. Fortinet is a fantastic, incredibly resilient cash printing machine. But is it a fantastic stock at today's premium price? The math strongly suggests you need some patience here. Thank you so much for joining me for this explainer. I really hope this structured trip through the data helped clarify the real intrinsic value behind the ticker symbol. Keep learning, keep analyzing, and I'll see you next time.